sold a property, received a bonus, or inherited a big sum and thought, should I invest this all in mutual funds right away? But what if the market crashes the next day? This is where STP, the Systematic Transfer Plan, steps in. It's a strategy that lets you ease into the market without risking your entire capital at once. In today's video, we will break down what STP is, how it works, why it's gaining popularity, and which STP strategy suits you best. So let's dive into the video. Hi there, welcome back to holisticinvestment.in, where we simplify the world of personal finance for individual investors like you. So imagine this, you have received 50 lakhs and you're ready to invest in mutual funds, but you don't want to time the market wrong. So a systematic transfer plan allows you to park your money first in a low risk fund like a liquid fund and then transfer it gradually to an equity mutual fund over time. Think of it like a SIP in reverse. Instead of putting money in from your bank account each month, you transfer from your parked funds into equity regularly, say every week or every month. This way, you reduce risk of entering the market at a peak, benefit from rupee cost averaging, and earn interest on your parked capital in the meantime. So let's take the example of Ramya, a 35-year-old investor. She sold a piece of land and received 50 lakhs. Instead of putting it directly into an equity fund, she first invested it in a liquid fund earning 6.5% annually. Then she started a weekly STP of 25,000 rupees into her preferred equity fund. So the result, she avoided investing the whole sum at a market high, earned steady interest on the idle money, and built wealth consistently through rupee cost averaging. So you might ask, why not just invest the whole amount directly into equity? The problem? Market timing risk. If the market falls right after your investment, you could lose a big chunk of capital upfront. STP reduces volatility by spreading your entry across time and keeps your money productive in the interim. Especially in uncertain or overheated markets, this strategy protects your peace of mind. So now let's talk about the three types of STP, each suited for different investor personalities. Number one, fixed STP for the disciplined investor. You decide a fixed amount and frequency and say 25,000 rupees weekly, and it gets transferred consistently from your liquid fund to equity. Simple, automated, great for salaried people with a bonus or beginners who want structure. Number two, capital appreciation STP for the cautious saver. Here, only the interest earned on your parked money is transferred. The principal stays untouched. Say you invested 10 lakhs and earned 5,000 rupees interest. Only that 5,000 rupees is transferred to equity. So this is ideal for retirees, great for those testing the waters in equity, and keeps your base capital secure. Number three is a flexible STP for the active and informed investor. This version lets you adjust the transfer amount based on market conditions. Market down, transfer more. Market high, transfer less. So it needs attention and analysis, works best with a financial planner's guidance, and perfect for market savvy investors. Still thinking whether STP is worth the effort? Let's explore 4 key benefits that make STP the go-to strategy for lump sum investors. Number 1, rupee cost averaging, which beats market volatility. So STP ensures you buy more when markets are low and less when they are high. So this averages out your cost and smoothen returns over time. Number 2, no more timing anxiety. Markets up, down. With STP, you don't need to predict the perfect moment. You invest gradually, removing the pressure of market timing. And number 3, capital efficiency. Basically, your money doesn't sleep. While waiting in a liquid fund, your money earns 6 to 6.5% returns. Way better than sitting idle in your savings account. Number 4, easy portfolio rebalancing. STP works both ways. Heading towards retirement, shift gradually from equity to debt, reducing risk as your goal nears. So how to set up an STP? So if you're ready to set one up, it's very simple. First, park your lump sum in a liquid fund. Then 2, choose your target equity fund. And 3, decide frequency, daily, weekly or monthly. And 4, pick amount, fixed, profit based or flexible. And number 5, automate and relax. You can pause or edit anytime. So a pro tip, use an STP calculator or speak to a financial planner to decide the best frequency and amount. So STP is perfect if you got a bonus or inheritance or sold property or nearing retirement and want to reduce equity risk and are anxious about investing lump sum in volatile markets. So it's not just a strategy, it's a mindset of discipline and balance. So what is the final takeaway? Let's face it, the lump sum investing can be nerve wracking, but doing nothing isn't safer either. STP offers a middle path, letting your money grow with patience, structure, and confidence. Still not sure which STP type suits you best? Talk to a certified financial planner today. We will help you design a transfer plan aligned to your risk appetite, time horizon, and financial goals, so your big money move doesn't turn into a big mistake. Click the link in the description to book your free consultation, because in investing, timing the market is hard, but entering wisely is simple with STP.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.